Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2. And today's lecture is for my intermediate accounting 1 students. And I want to acknowledge that I will be using the McGraw-Hill materials from the textbook called Intermediate Accounting. Spiceland, Nelson, Thomas books, great book. And so I want to give them credit as I work through these problems do come from their textbook. And I would add here, I think accounting, it's important to practice. And so this is your chance. I'm going to be working here, but here's how you can practice. Once you see the problem on screen, you pause the video. I'll probably try to pause a little bit. I forget because I'm moving along here. I want to get this done as you do as well, I'm sure. But you could pause the video, go do today's exercise, all journal entries, go do the journal entries yourself, and then restart the video and see how I worked it. And maybe you'll see some tips and the way I think about it and then do it, it might be helpful to you. So with that, going to get started. Time to go to work. All right, here we go. And so we're going to do 3 different exercises, and there's about 5 or 6 journal entries required for each of these. And so it's really important to look at the information here at the top. You know, always read this carefully, because if you're working a problem like this for an exam, you want to make sure you got the facts right. And so number 1 fact, these are the adjusting entries for the period ended December 31st. That's going to matter here as we get to 2021. And we're going to assume no financial statements were prepared for the year. So when we do these adjusting entries, we're not doing it just for the month of December. We're doing it for the whole year of 2021. And that matters. You have different answers, you know, otherwise. So let's start here with number 1. A 3-year fire insurance policy was purchased on July 1, you know, halfway through the year for $12,000. And, you know, I do not like what they did. The company debited insurance expense for the entire amount. So 1, let's just look at that. Insurance expense. And prepaid insurance. They didn't, I would have preferred that they had booked that to prepaid insurance, but they booked the entire thing, $12,000 to insurance expense. Well, that's wrong. But now we're going to adjust that. We're going to correct. So we got to see how they did it so we can correct it. Now, in all these problems like this that are deferrals or prepaid things, what I think is a good practice, just do all these the same way. That's what I do. And I say, okay, how much is this cost for this insurance per month? So they paid $12,000. And for how many months they paid this for? It says it was a 3-year policy. So they paid for 36 months. So I take 12,000 divided by 36. So 333.33 per month. That's how much it cost us. So how many months in 2021 did we benefit for, you know, starting with July 1, so July, August, September, October, November, 6 months. So times 6, that should be our insurance times $2,000. I love to do like make it easy, but I'm going to go ahead and put this as 12,000 what they did. So we should only have 2,000. I love T accounts. It just puts it in the pictorial. I think you know, less chance of making a mistake. So they've got a debit sitting there for 12,000. They should have a debit of 2,000. What do they do? They need to credit insurance expense. And what they need to debit? Prepaid. And so at the end of the year, we end up with $10,000 prepaid. So the adjusting entry here is going to be debit prepaid expense for 10,000 and credit insurance expense for 10,000. Now, this is kind of the opposite of the way we normally look at these problems, because usually, normally they would put the whole 12,000 in the prepaid. I'd prefer they do that, and then have zero insurance expense, and then we would go debit insurance expense for 2,000 and credit prepaid insurance with 2,000. 12 minus 2, we still end up in the same place. So I think what's good about this problem is that you have to think about it, and that makes it a better deal. Number 2, depreciation expense was 15,000 for the year. Well, that's pretty easy. I don't have to do any math on this. Debit depreciation expense for 15,000. And what do we credit? A contra account called accumulated. So we credited this, and so that is a reduction in the asset. That now we've used that asset, and it's, probably some type of long-term asset used for several years. Okay, number 3. Okay, we have employee salaries. So employees work for the month of December, and they provided services worth 18,000, and we're going to pay them that 18,000 next month. Well, we are accrual-based accounting, so we've got to take care of that now. Debit salary expense for 18,000 and credit salaries payable for 18,000. Now, this is a good one to just stop and think about the purpose of accrual entries. If we did not record this adjusting entry, we waited till January and debited salary expense when we paid them, the results for the accounting period would be wrong, because we got the benefit, $18,000 worth of benefit. And by the way, we also have a liability, we owe them. So if we didn't book this adjusting entry, our income statement would definitely be wrong. Our income would be too high by 18,000, and we'd be missing the liability. So that kind of shows us the purpose of all these. And the same thing is true for number 1 and number 2. Number 4, the company borrowed $200,000 from a bank with interest at 12%, and it's not going to be paid till April 20th of 2022. Well, first of all, I know that's a current liability because it's going to be paid in the next year, but that's not what they're asking for here. What's happened here is both, note what it says, both the principal and the interest will be paid in April 20th, 2022. But what happened? We have incurred some interest expense. We've been using someone else's money at a cost of 12% for every 12 months we use that money, because interest rates are always provided at a 12-month rate. Well, I'm going to do this problem like I did up here with the first one. I'm going to calculate what's the cost of interest per month. So I got 200,000 times the interest rate, which is 12%. And so that's going to be, I'm going to take a chance here, $24,000 per year. Okay, how much per month? 24,000 divided by the 12 months in a year. It's $2,000 per month. So every month where we have this note outstanding, we have a real expense of $2,000. Now we're trying to do the accounting for 2021. So how many months has this note been outstanding? Okay, the full month of November and the full month of December, 2 months. So I got to do 2,000 times 2, 4,000. So debit interest expense, because we had this expense for 4,000, but we're not going to pay it until April. So we have a liability. We call this liability interest payable. Easy stuff here. Okay. Number 5. Okay. Now we're receiving money. We received $3,000 in cash from another company that is renting office space in the building. And this payment represents rent for December, January, and February, 3 months. Same thing. How much revenue, because this is now income for us, rental income, do we earn per month? We got an upfront payment of $3,000 divided by $3,000 per month. How many months were they renting our office space? December 1 to December 30, but just 1 month. So I'm going to let's see what they did. So they did do it right when they recorded this. They, unlike the prepaid, they debited cash and they credited deferred rent. So that $3,000 we have right now in the books, $3,000 of deferred rent, and we got to reduce that by 1 month because they've used one of those 3 months. So debit deferred revenue, 4,000, and I'm going to credit real revenue, rental revenue, 4,000. Remember, this deferred revenue is a liability account, and that we created on December 1st. And you know, why is it a liability? Well, we owe this company the right to use this space for 3 months, and they paid for it up front. So now they've used it for a month. So what do? We got to reduce that liability by 1 month's worth of the rent. And so that is a debit, reduces a liability for 1,000. And we get to recognize on the income statement, income, $1,000 revenue, rental revenue. That's a good thing. Okay, number 6, assume that they did it wrong and they did the whole 3,000 to rent. I got to do my T account again when I do these. So rent revenue, they put the whole 3,000 there, but they put nothing in deferred revenue, which I would have preferred that they do it that way. What should rent revenue be? We just calculated that, 1,000, because they used it for 1 month. And you know, they didn't put anything there, but now we got to create something. How do we take 3,000 in revenue that's sitting in our books now to what it should be, 1,000? Well, we've got to debit that by 2,000. And therefore we debit that and we credit deferred revenue for 2,000. So the entry would be debit net revenue. Oh, I'm sorry, 2,000, not 1,000. And credit deferred rent revenue for 2,000. Now let's compare that to number 5. Now let me just do 5 and T accounts. So rent revenue. This would be a good way of looking at this. Number 5, they credited deferred revenue for 3,000. And then we did a journal entry to recognize the 1 month's worth of revenue. This is our answer to number 5. If we go back, that I did this problem right there. Number 5, we debited deferred revenue for 1,000, credited rent revenue for 1,000. We do that. Now let's go add up our debits and credits. So rent revenue, we only have $1,000 credit. Here we have 3,000 minus 1,000, 2,000. Exactly, end up in exactly the same place. So regardless of how we handled it on December, I think that was December 1, when we do our adjusting entries, we don't care how you handle on December 1, because we're going to get our financial statements right with adjusting entries. And this may be the procedures this company follows. Just throw it all in written revenue. We'll fix it at the end of the year. There's some accounting steps. That's the way they do it. You know, I'd kind of prefer to do it right up front and put the whole thing in deferred revenue, but that would be me. And it doesn't matter as long as you get to the right place, because at the end of the year, December 31st, we owe them 2 more months at $1,000 per month. So we have deferred revenue of 2,000, and they did use it for 1 month, and so we got rent revenue for that 1 month. Remember, we calculated out $3,000 for 3 months. That our rent revenue should be $1,000 per month, and we got that for the month of December. See how just beautiful the accounting is here. All right, new pencil, new problem. Exercise 2-9. Better keep me honest here. Make sure I don't screw up. I have the answer sheet, but you're not allowed to have that on the exam. Only us professors get that. So, all right. Let's look at the facts. Again, this is another December 31st situation. And again, we're assuming that no financial statement prepared during the year and no adjusting entries were recorded. Okay. Oh, you know what? That's not the right. I said, that looks too similar. There we go. Now we're good. All right. Now let's look at this. Again, it is December 31st, 2021. And we assume the financial statement period is no adjustment. So it's the same set of circumstances, but it's a new problem. So number one, the company lent $90,000 to another company. So another company is using our money. And so we're earning interest every day that they're using our money. And so for the year of 2021, looks like they used our money for October, November, December, 3 months. Well, I like to follow that same process. How much is interest are we earning per month? 90,000 times 8%, that's 12 months of interest, 7,200 for a year, divided by 12, $600 per month. So we are earning 3 months. We're earning for every month they're using our money $600, but they're not going to pay us until September of 2022, when they'll pay the interest and principal, everything. So we've got to go accrue. This is our accrual entry. Debit, interest receivable for those 3 months. 3 months times 1,600, 600, I mean, 1,800. And we've got to credit interest revenue. You can imagine banks are doing a lot of these interests, these journal entries, but that's their business, is loaning other people money. All right. Now, the company paid its landlord $6,000 for the months of November, December, and January. So how many months they pay for? I'm going to follow my same process. 6,000 divided by 3 months. So this rental is costing us, because we are the lessee. We're renting it from the landlord. It's costing us $2,000 per month. How many months do we use it for? November in 2021, November and December. So debit rent expense for 2,000 times 2, 4,000, and credit prepaid rent. Okay. This is so much like principles of accounting so this is, almost too easy, but that's okay. You got to start a little bit slow. It's gonna get a lot harder as we move through the course. So here now we are renting something to another company, and we receive $12,000 in cash. And so they did it what I would call the right way. They debited cash for $12,000 and they credited deferred rent revenue. So right now we have $12,000 sitting in our deferred revenue. And so let's see how much it costs per month. I just follow that same process. 12,000, and how many months did it say we did that for? Represents 1 year. So divided by 12. So in this case, this is per month. We're earning rental revenue of $1,000 a month every time, every month that they're using this portion of our factory. So again, we're trying to do the adjusting entries. We still just have the whole 12,000 sitting in deferred revenue, but they've used it now. How many months do they use it? So August, I usually just have to count on my fingers, sorry, but August, September, October, November, December, 5 months. Sometimes you see, one good thing about following this, the process, same way every time, like I'm doing for all these adjusting entries. It's a process, you practice it, you get an exam, you do the cost or the revenue per month, whatever it is, give me the number of months. I got it, easy. And this time, 5 months. So 5 times 1,000, I'm going to debit my deferred revenue for 5,000 and credit my revenue for 5,000. We call it rent revenue or whatever you want to call it. I'm not going to give you a hard time as long as you get the deferred part and actual revenue right. Number 4, easy now, harder later when we calculate depreciation. They just give it to us, and that's an easy debit depreciation expense. For 4,500 and credit our contra asset account. Number 5. Okay, vacation pay. That's interesting. So employees are earning vacation, and so there's 8,000 that they've earned, but they haven't taken it yet. Vacation pay becomes interesting. We get to 3120 because it's going to matter is can they still take it in the following year? And in this case, sounds like they can. Some companies have a take it or lose it policy. So if you don't take it by the end of the year, you lose it. Therefore, you wouldn't have a liability at the end of the year. Think about these vacation policies, but here we keep it easy for you. And so we're just going to debit vacation expense because they earned it in 2021. And we still owe it to them because of the way the policy works, 8,000. And credit vacation payable. Some vacation becomes rather complicated in certain companies and how you calculate and how you capture all that. So you know who's taking vacation, who do we owe vacation, how much do we owe them? It becomes a bit of a challenging issue for accountants. And then now we're doing a supplies problem. I do kind of love these problems just to let you know. So I like to do a T account, supplies. So we started the year with 2,000 in the supplies account. And then we purchased 6,500 in supplies, debit that. And then we want to expense how many of those we use. So we have 8,500 available to be used. And we don't know how many we use, but we do know this, how many we have left. 3,250. So that's what the supplies account, that's the balance we got to end with. How do we get there? We got to solve for X. What credit will take these two debits down to 3,250? So 8,500 minus 3,250 equals 5,250. Again, 8,500 minus 5,250 equals 3,250. So we got to credit the supplies, the asset account. And what do we debit? Supplies expense, because we use them. And so debit supplies expense, because we want to expense these in the period that we use them. That's important. So we get our income statement right. It reflects the supplies that are missing that got used. And we get our supplies account right, because that's the right balance. We went out and counted it. We know that is right. We have verified it. If you go back to chapter 1 and some of the principles, the concepts that we, conceptual framework that we have to think about for accounting. All right. Now is the last problem. And this one's going to be a little interesting. I do like this one coming from a public company, because it's a, if I remember correctly, it's a quarterly financial. And so let's look at that. Well, no, their fiscal year end is June 30th. So we are doing the year end accounting, but the company, like most public companies, issues quarterly financial statements. And so adjusting entries are done every quarter. So now, we're doing the adjusting entries for 3 months, because every quarter, January, February, March, they did their adjusting entries at the end of the March. So now we have April, May, June. So this is a bit of a curve than some of the other two problems that we've seen. And so you have to, think about it a little bit differently. And so let's look at, let's go through the problem here. So on December 1st, 2020, last year we paid $6,000 for annual 1 year. So let's just do our process. 6,000 divided by 12 equals 500, right? $500 per month. And so we've got to record insurance expense at $500 a month. Now, this is interesting. We're not doing the whole year, because they already did it. They did the adjusting entry at the end of March. We only have to count for 3 months, that being April, May, June. So times 3, we're going to debit insurance expense for 1,500 and credit our prepaid. So we did a similar entry back in March. So now we're only have to do 3 more months. So this is an interesting curve that gets you thinking a little bit. All right, now we have borrowed $80,000 from a local bank, again, all the way back to last year in 2020, and earns interest at 8%. And it's going to be paid back August 31st, which is in a couple of months. So follow our process, and it's at $80,000 times an annual rate, 8%. And so 6,400 per year divided by 12, how much per month? $533.33. All right. How many months do we need to account for? Well, since our, again, adjusting entries were done at the end of March, we're only doing 3 months. So we're going to debit interest expense, because we're using someone else's money. $533 times 3 equals 1,600. And we're going to credit our interest payable. for 1,600. All right, number 3. Manzanti owns a warehouse that it rents to another company on January 1. So now this is, our company's warehouse, and we're renting it. So we're going to get rental income. And we received $24,000 back in on January 1. And it's for the whole year. And divide by 12. So it's $2,000 per month. How many months are we accounting for? 3, because we did adjusting entries in March. And so it's going to be debit deferred revenue for 6,000, 3 months, and credit real revenue, rental revenue, not deferred. And this represents April, May, and June for this quarter. Number 4, depreciation expense for the office building is $20,000 per year. Well, how much for 12 months? How much for just 3 months? Because we're only doing 3 months. I just divide that by 4 equals 5,000 for a quarter. Now you could have done that by month, 20,000, which would be 1,666 times 3, 5,000. But I just know, hey, the years divided into quarters, 1/4. So I did do a shortcut for my normal process, which I don't know, maybe that's not good. Maybe better if you, whatever you feel more comfortable with, but this was just such an easy one to divide by 4. And so debit depreciation expense for 5,000, credit accumulated. Number 5, employee salaries for just the month of June were 16,000, and they're going to be paid later on July. So we just got to go do that entire amount. Salary expense, 16,000, and credit salary payable. And that's the end of exercise 211. And that's also the end of me working adjusting entries. And again, continue to say this, practice makes perfect. You do not want to show up on game day, the exam day, never having practiced these. I know it's kind of grunt work, but go work through all three sets of these problems, and you'll get the hang of it. You'll come up maybe with your own processes to get to the right answer. And then when it's game day, boom, you knock it out. I see some of my students who do these very problems. They do it so quickly. I do see them counting on their hands too. So they're following my tips and my process. So guys, I wish you the best on adjusting journal entries. And remember, these are important. And it's not just measurements. This is also primarily about reporting, trying to get our balance sheet right and our income statement right. Either recording an expense and credit and taking care of the liability, or recording revenue and reducing the liability in the case of deferred revenue. Anyway, just crucially important part of accounting. Even though this is a review from Principles of Accounting introductory course, it's a good review because you've got to have these down pat before we start moving into the hard stuff. All right, thank you guys, and good luck.